Is the artificial intelligence revolution we are all witnessing a ticking time bomb? According to one of Wall Street's most respected minds, the current AI stock market mania is not just a replay of the dot-com bust, he says it's even worse. That's the stunning warning coming from Torsten Sløk, the chief economist at the financial giant Apollo Global Management, and it's sending shockwaves through the investment community. He is directly stating that the sky-high valuations we're seeing in beloved AI stocks are more extreme and more dangerous than the peak of the tech bubble in 1999. So what is he seeing that has him sounding such a loud alarm? Are we all partying like it's 1999, completely oblivious to the cliff edge just ahead? Today, we are going to dive deep into this stark warning. We will unpack the exact data that shows how today's market has eclipsed the dot-com era's excesses. We'll expose a hidden danger in the world's most popular investment, the S&P 500, that could mean your portfolio is far riskier than you think. And we'll look at corroborating evidence from other analysts who are seeing frothy conditions and vertical charts that scream caution. Is this the beginning of the end for the great AI rally, or just a healthy dose of skepticism? Let's find out. To truly grasp the gravity of Sløk's warning, we need to travel back in time. Let's rewind the clock for a moment, back to the final, frenzied years of the 20th century. The dawn of the public internet had promised a new world, a new economy. It was a time of unbridled, almost religious optimism. We saw the birth of dot-com companies, many with bizarre names and even more bizarre business plans, raising hundreds of millions of dollars without ever having turned a single cent of profit. This was the era of eyeballs over profits, where a company's value was measured not by its revenue, but by how many people visited its website. We saw companies like Pets.com, famous for its sock puppet mascot, raise and burn through millions in venture capital and Super Bowl advertising, only to collapse less than a year after its IPO. We saw Webvan promise to revolutionize grocery shopping, building massive, expensive warehouses before it had the customer base to support them, and spectacularly flaming out. It was a time when a business plan scribbled on a napkin could secure millions in funding, as long as it had the magic .com attached to it. The mantra was, get big fast, and fundamentals like revenue and profitability were dismissed as relics of a bygone era. Valuations soared to levels that had absolutely no connection to financial reality. We all know how that story ended. The bubble burst. The Nasdaq index, home to most of these tech darlings, plummeted by nearly 80%. Trillions of dollars in market value evaporated into thin air. Fortunes were wiped out overnight. Dreams of a new paradigm turned to dust. It was a brutal, painful lesson in market gravity, a reminder that valuations, eventually, always matter. This is the ghost that haunts the market today, and Torsten Sløk is arguing that this ghost is back, and it's bigger than ever. He poses a simple yet profound question that every investor must ask themselves. Yes, AI will do incredible things for all of us, he says. But does that mean I should be buying tech companies at any valuation? The implied answer is a resounding no. So what is the concrete evidence behind this alarming claim? Sløk points to one of the most fundamental metrics in all of finance, the price-to-earnings ratio, or PE ratio. In simple terms, the PE ratio tells you how much you, as an investor, are willing to pay for every single dollar of a company's annual profit. A low PE might suggest a company is a bargain. A high PE ratio suggests that investors have very high hopes for that company's future growth, and they are willing to pay a premium for it today. During the dot-com bubble, PE ratios for tech companies went into the stratosphere. Well, according to Sløk's research notes sent to Apollo's clients, we have now officially entered uncharted territory. His internal data shows that the average price-to-earnings ratio of the 10 largest and most powerful companies in the S&P 500 index has now eclipsed the PE levels seen at the absolute height of the dot-com bubble in 1999. Let that sink in for a moment. The price tag on today's market leaders, the giants like Meta and the undisputed AI king, NVIDIA, is now, by this metric, more expensive than the price tag on the tech darlings right before the biggest market crash of the modern era. This isn't just a mild warning sign, it's a giant flashing red light on the market's dashboard, suggesting that the euphoria may have once again overtaken rational analysis. But the danger doesn't stop at just sky-high valuations. Sløk uncovers another, perhaps more insidious, risk that affects millions of everyday investors who believe they are playing it safe. He calls it a dangerous concentration of exposure. For decades, financial advisors have preached the gospel of diversification. Don't put all your eggs in one basket. The easiest way for most people to achieve this has been to buy an S&P 500 index fund. You give your $100, and in return, you get a tiny slice of 500 of America's biggest companies. It's supposed to be a safe, diversified, broad market bet on the health of the entire US economy. But Sløk argues this is now a dangerous illusion. He points out that today, almost 40% of the entire S&P 500's value is made up by just the 10 largest companies. 40%. So, as he puts it, if I take $100 as an investor and buy the S&P 500, I think I have exposure to 500 different stocks, but I'm really just betting on the NVIDIA and the AI story continuing. Think about that. Your supposedly diversified retirement fund is now making a massive, concentrated bet on the continued meteoric rise of a handful of tech giants. It's like thinking you've bought a ticket for a cruise on a massive, stable ocean liner, only to discover you're actually on a speedboat strapped to a few giant rockets. The ride is thrilling, but if one of those rockets sputters, the whole thing could flip over. This phenomenon is what market technicians call poor market breadth. A healthy market rally is like a rising tide that lifts all boats. Many different sectors and stocks participate in the upward move. A rally with poor breadth, like the one we are seeing now, is a rally where only a few generals are marching forward while the rest of the army stands still or even retreats. Historically, this is often a sign of an exhausted market, one that is vulnerable to a sharp reversal. The very foundation of passive investing is built on the idea that you are insulated from the failure of any single company. But when just 10 companies dictate nearly half of the index's movement, companies like Microsoft, Apple, Amazon, Alphabet, alongside Meta and NVIDIA, that safety net becomes dangerously thin. If this hidden risk lurking within the most common investment in the world is something you find eye-opening, do us a quick favor and hit that like button. It helps us understand that you want more deep dives that peel back the layers of the market. This concentration means that a downturn in a few specific names, driven by a potential souring on AI sentiment, wouldn't just be a tech sector problem. It would be a problem for the entire market, and for anyone who owns a simple index fund. Now, you might be thinking, is this just one economist's pessimistic view? Is Torsten Sløk just a lone voice crying wolf in a sea of bullish optimism? The answer is a clear no. Other analysts on Wall Street are looking at the market through a different lens and arriving at a very similar, unsettling conclusion. In a note to their clients this week, analysts at the firm BTIG flagged their own warning signs, describing the current market sentiment with a single evocative word, frothy. Frothy, like the head on a beer, is bubbly, light, and unstable. It suggests a market that is high on excitement and low on substance, raising the very real possibility of a near-term pullback, especially in those high-flying AI names. BTIG's focus wasn't on PE ratios, but on investor sentiment itself, and they used a fascinating tool to measure it, the Buzz Next-Gen AI Sentiment Index. This index is designed to track the stocks that are getting the most positive online buzz, the ones that are most popular with retail investors. It's a direct gauge of market euphoria, and the readings from this gauge are staggering. The index is up an incredible 45% over the past 16 weeks alone. It is currently trading 29% above its 200-day moving average, a technical indicator that suggests an asset is heavily overbought. According to BTIG, both of these readings are at their highest and most extreme levels since early 2021. And what happened in early 2021? That was the absolute peak for speculative tech stocks, for meme stocks, For all the assets that were fueled by stimulus checks and lockdown boredom before they came crashing back down to earth. Think about the psychology at play. In 2021, it was social media platforms like Reddit's Wall Street Bets that fueled the frenzy around meme stocks. Today, the conversation has shifted to AI, but the mechanism is eerily similar. Retail investors, bombarded with headlines about AI's world-changing potential and seeing stocks like Nvidia post astronomical gains, are gripped by an intense fear of missing out, or FOMO. This sentiment is amplified by social media influencers and financial news that often focuses on the winners, creating a powerful feedback loop where rising prices attract more buyers, which pushes prices even higher, completely detached from underlying fundamentals. This is the very definition of a frothy market. The parallel is eerie and unmistakable. Jonathan Krinsky, an analyst at BTIG, adds a crucial layer of nuance to this warning. He acknowledges the power of momentum. Can it get more so like it did in 2020 to 2021? Of course, he wrote, admitting that a bubble can always get bigger before it pops. But his tactical conclusion is firm. This feels a bit extreme to us. They are not necessarily calling for an immediate crash, but they are strongly suggesting that the risk-reward balance has shifted dramatically. The potential for further gains is now weighed down by the much heavier risk of a sharp correction. And just like Apollo's team, BTIG didn't just talk about the market in the abstract, they pointed to specific areas of concern. They highlighted the vertical chart patterns of some of the index's top holdings, including popular names like Rocket Lab, Coinbase, and Unity Software. A vertical chart is exactly what it sounds like. The stock price has essentially gone straight up. While thrilling for those who got in early, these patterns are notoriously unstable. They often reflect pure momentum chasing, not a sober assessment of a company's value, and they are incredibly vulnerable to what the analysts call short-term shakeouts, a polite term for a sudden and painful price drop. The warning is clear. Stocks that go up like a rocket often come down like a rock. So with all these warning signs flashing, from historical PE ratios to extreme market concentration and frothy sentiment, what are investors supposed to do? It feels like being caught between a rock and a hard place. On one hand, the long-term potential of artificial intelligence is undeniable and transformative. You don't want to miss out on the next great technological revolution. On the other hand, the short-term risks of buying into a potential bubble are terrifying. The BTIG note offers a potential path forward for those growing uneasy. They suggest that investors should consider rotating out of the high-flying speculative names and into more defensive sectors. What does that mean? Defensive sectors are industries that provide essential goods and services, things people need regardless of whether the economy is booming or busting. The logic is simple. These companies provide products and services with what economists call inelastic demand. People will continue to pay their electricity bills, buy toothpaste, and purchase basic food items even if they cut back on luxury travel or new gadgets. This creates a stable, predictable stream of revenue and earnings that tends to hold up much better during an economic downturn, providing a potential safe harbor in a stormy market. It's a strategy of moving from the high-stakes poker table to a safer, more predictable part of the casino. Interestingly, the note also floated a more contrarian idea, looking at Chinese tech stocks. This might sound surprising given the geopolitical tensions and regulatory crackdowns, but the logic is based on valuation. While US tech stocks have been soaring to new highs, Chinese tech has been beaten down and consolidating for months, if not years. The argument is that the pessimism might be overdone and these stocks could be undervalued, offering a better risk-reward proposition compared to their euphoric American counterparts. This tension is not new. In fact, it is a recurring drama that has played out across centuries of financial history. From the Dutch tulip mania in the 1600s, where single bulbs were traded for the price of mansions, to the South Sea bubble in the 1700s that financially ruined even Sir Isaac Newton, great innovations and compelling stories have always been fertile ground for speculative excess. The promise of canals, then railroads, then radio, then the internet, and now artificial intelligence has always followed a similar pattern. A genuine technological leap creates a powerful and true narrative, which is then hijacked by financial speculation, driving asset prices to unsustainable heights before an inevitable and painful correction. The technology itself usually survives and thrives, but the fortunes of those who bought in at the peak of the mania are often lost forever. Ultimately, what we are witnessing is a great and growing split in the market. It's a battle between two powerful forces: the long-term, undeniable optimism surrounding the potential of AI to reshape our world, and the near-term, data-driven concerns that investor enthusiasm has gone too far, too fast. We have the ghost of 1999 being invoked by Apollo, warning that valuations have exceeded even that infamous peak. We have the hidden danger of a market so concentrated in just a few names that the very idea of diversification is being called into question. And we have firms like BTIG pointing to frothy sentiment and vertical charts that are historical precursors to sharp pullbacks. The question for every single investor is no longer if AI is a big deal. The question is whether the current stock prices already reflect not just that reality, but a perfect, flawless execution of that future potential, a scenario that rarely, if ever, comes to pass without some bumps along the way. The debate is raging on Wall Street, and we'll be tracking every development. To make sure you don't miss our next update on this critical story, hit that subscribe button and join the conversation. History teaches us that while technology propels us forward, human psychology, our tendency towards greed and fear, never really changes. And right now, the needle seems to be pointing firmly